The countdown is on. Everything you need to get the edge at the end of the market day. This is The Close.
Let's get a check on exactly what's going on in the market right now, because you have the S&P 500 down more than 2%. You're looking at the worst day intraday since December of 2022. A deeper sell-off yet in those tech-heavy names, including the NASDAQ 100 down 3.4% nearly. Philadelphia Semiconductor Index now down 4.6%. That rotation into small caps not holding up today either, 1.5% lower, although less declines there than you see in those more tech-heavy indices. Scarlett.
Yeah, and driving the tech-heavy sell-off is, of course, a reality check following earnings results from Alphabet and Tesla, which show all the money they've poured into AI has yet to create meaningful ROI. So let's kick things off here with that screen of red and bring in Jan van Eck. He is Van Eck Associates CEO. Jan, thank you so much for joining us today. The earnings for those two tech giants disappointed investors, and analysts actually said that this may be the year when the market starts talking about the so-so seven rather than the magnificent seven. Do you think the sell-off we're seeing right now is proportional to what we heard from the companies?
Absolutely. The way I look at it is you can have a very solid company, but a very bad stock. And what I mean by the stock is it's just overvalued. And so I look at NVIDIA as like the super darling of the era, and it's selling it forward like 32 times earnings. That's just really aggressive, right? So you need 32 years to make back the cost of your investment, 32 years of profits. I think from a multi-decade view, growth has only been this valued against growth since in 1999, right? That's the internet bubble. The NASDAQ was down 50% for the following 7 years. So when you have a regime change, and that's why I'm ringing the bell right now, things can really change dramatically. And now you're getting a confirmation today of some of the action you've seen over the last couple of days.
Yeah, we're looking at, again, red across the board here for the major indexes. But when you look at the year-to-date moves, 14% gain for the S&P 500, 15.8% gain for the NASDAQ Composite. You talked about good companies, but bad stocks. At what point do these become good stocks?
A lot lower valuations. I mean, I think, NVIDIA before the last 5 years was selling at sort of 15 times forward earnings. So the stock could go down 50%, and the company continues to report solid margins, which are a risk. No supply chain problems, which are a risk. No competition, which is also a risk. So I've listed major risks that could make the company more challenged, but meanwhile, the stock could fall easily. And once you have this change in momentum, you don't want momentum against you.
Well, how much momentum is there to a trade like this? Is this a day, or is it starting a greater type of psychology in investors right now? Do they need to hide somewhere that's not those same 7 to 10 stocks they've been hiding in?
They need to hide. The problem is all these indices globally are overweight the Mag 7 because they're market cap weighted. It could be global index. It could be a large cap, right, that includes these mega caps. It could be an all cap that includes these mega caps. Like, people over-own these almost everywhere in their portfolio. That's why I'm ringing the bell. Like, look at how much your exposure you have to the mega caps and rebalance.
To that end, too, a lot of people have been saying it's been a passive market for a long time now. Doesn't need to stop being a passive market. How do you strategize around that?
I mean, as an ETF issuer primarily, we talk about look at your asset allocation, right? And so I'm not saying get out of equities, but even you could be in large caps. You don't have to go to small caps or mid caps. So it's just really balancing your equity book that I think investors need to be looking at.
So treasuries were gaining, pushing yields lower, but that has kind of reversed a little bit over the last hour or so. We now have the 10-year yield moving up by 3 basis points. Earlier today, we heard from Bill Dudley, the former president of the New York Fed, writing in a Bloomberg opinion piece that he has changed his mind, and it is now time for the Federal Reserve to cut interest rates, and waiting until September increases the risk of a recession. Would a rate cut next week, at the end of July, signal panic, or would it provide relief to risk assets?
I don't, look, I'm not that worried about risk assets, but I don't think they're going to be that easily assuaged from their concerns. What I look at from the sort of policy Washington, D.C. perspective is 2025. That's when you have a lot of fiscal pressure. All this government spending that's coming up now, and timing is everything in financial markets, right? But I think the markets and I think the Fed are looking to that kind of what is a Trump administration, what is a Harris administration going to do on the spending side? Because our deficits are huge now, but with entitlement spending coming in, they're going to get worse.
As an ETF issuer here, how much pressure do you feel to diversify pretty hard into other asset classes? Not even, I know you're one of the Ethereum issuers as well, but bonds, active ETFs. How much more option do you need to give people in a market this volatile?
Yeah, we love the short end of the fixed income, and we've been saying that. Not that we don't think the Fed is gradually going to start easing, and with the weak earnings, this earnings cycle, and a little weakness in Q2, it might accelerate until next week. But no, I love fixed income as a diversifier. It's just like you get paid to be short. Why take the duration risk right now? So that's what we've been pushing for.
On Ethereum, by the way, too, it's a really interesting time because no risk asset is getting a bid in this market here. What has it been like to experiment in this way right now?
Don't trigger me. Bitcoin is up today. Bitcoin, and we're big believers in Bitcoin and gold. So Bitcoin is rallying. I do think Ethereum is a very different blockchain software technology. It's got, what I emphasize is the risks. It's got competitors. It had to cut prices last year to match Solana, and it's been losing market share. So Ethereum is not kind of I shouldn't say that Bitcoin is a no-brainer, but it's a very different investment proposition. And I think Bitcoin is definitely a diversifier, as are commodities and other real assets.
It's a different pitch than Bitcoin, essentially.
Yes.
All right, Jan, thank you so much for joining us. Jan van Eck is Van Eck Associates CEO. And I'm so glad we talked about Ether and crypto because coming up, Trump turns to crypto. The former president is set to deliver the keynote at the Bitcoin conference underway in Nashville. We're going to discuss his pivot on crypto.
Plus, Dan Ives of Wedbush is going to talk about tech with us as the start of the earnings season really is failing to impress investors here.
And shares of Lamb Weston sinking the most on record. More on what analysts are calling a disastrous report. It is our stock of the hour. We've got more on all of that coming up. This is The Close on Bloomberg.
Season is here.
We're skating into another earnings season.
The expectation for earnings going forward are quite high.
Bloomberg is first to break the numbers.
Adobe earnings crossing
earnings out of Broadcom.
JP Morgan, we get Citigroup, we get Wells Fargo.
There is something for everybody.
With the smartest insights.
Now banks have earnings power.
There's a resilience in the bigger cap companies.
We're not talking about a collapse in earnings for technology.
We will have full and instant analysis.
Continuing coverage on Bloomberg. Context changes everything.
It's time now for our top calls that look at some of the big movers on the back of analysts' recommendations. We'll start with Lockheed Martin, an upgrade to buy from hold at TD Cowen. The defense company reported earnings yesterday that topped estimates, reflecting robust demand abating supply delays felt in the quarter. The analysts also highlighting the restart of F-35 deliveries as a win. The stock up by almost 3%. Next up, Ulta Beauty needs to watch out for Sephora. That is the view over at Piper Sandler, which downgraded Ulta to neutral from overweight. Analyst Corinne Wolfmeyer says she expects Sephora to issue a, quote, rather lackluster long-term plan at its investor day in October due to increased competition, excessive promotions, and margin dilution. The stock off by 5.25%. And finally, General Motors getting cut to equal weight at Morgan Stanley. GM's improved capital discipline makes it one of the best performing major auto companies this year. However, the analyst says he can't ignore headwinds such as pricing pressures along with EV and China risks. GM shares little change, but up just a touch by 0.1%. And those are some of our top calls. Let's stay with autos because the worst performer in that sector is Tesla after it reported yet another quarter of disappointing profit. Elon Musk has been trying to steer the company's future to autonomous taxis, the stock plunging after he confirmed a delay in its robo-taxi event.
I wanted to make some important changes that I think would improve the vehicle, the sort of the robo-taxi, the main thing that we're going to show. And we're also going to show off a couple of other things.
Here in studio with his take is Dan Ives, senior analyst at Wedbush. He has an outperform rating on Tesla. So the market reaction we're seeing in Tesla today, it's pretty extreme. How much of this is because Elon Musk tried to pivot to this idea of robotaxi and then couldn't deliver because he had to delay the whole event?
Yeah, I mean, I think it sharpens the knives between the bulls and the bears. Because the bears will argue gross margins missed, price cuts continue to happen, and lower ASPs. But in my opinion, this story is about AI, robotaxi, robotics. And really, actually, a price stabilization that's happening, and I think demand that ultimately is starting to turn the corner in China. So for me, I'm actually more bullish today on the Tesla autonomous robotaxi story than 24 hours ago because you got the date. I think outlined maybe what I believe is going to be sort of the prototype, and actually pretty bullish on where they expect to actually start to see a dent. He said later this year, I think potentially into next year.
All right, we have a date for the event, which is October 10th, but we don't have a date for when things actually get going. And he's notorious for kind of pushing things off into the future. In the meantime, Tesla doesn't have enough of a lineup to really get people to come in and buy its existing cars. So what does Tesla do until the robotaxis really trickle down to the bottom line?
So you go back 3 months ago, obviously stock's 140, the bears thing is going sub 100. Look where it is today. So the point is, the reason we are where we are today is investors are now starting to recognize the AI story. I think Tesla is the most undervalued AI play out there. We think AI alone could be worth $1 trillion to the name, as also this name is stabilizing from a demand and pricing perspective.
I'm going to ask you what Elon Musk has been asking users on X. Should he invest through Tesla $5 billion in XAI?
We've said it, we've talked about publicly, this is a no-brainer. Because to me, it's all about Tesla further and further doubling down on the AI story. And I think that's what investors want to see. I have never, from the beginning, viewed Tesla as an auto company. I view it as a disruptive technology name. But that's why, look, the bears are going to come out today. They definitely on the margin miss. That's why the stock's down. But I believe we sit here weeks, months from now, and investors now start to focus more and more on 10-10.
You know, we could talk about that aspect of things forever when it comes to Tesla, but we got to switch gears to talk about Google as well here, Alphabet. What is going on? I mean, you look at the NASDAQ 100 and we're looking at something that looks a little like a tone change. How do you feel about the sell-off?
I mean, if you look at it's an A+ quarter. You could argue YouTube and what they're spending on CapEx, but that's good money that you want to see because what are they spending on? AI. To some extent, Google is narrowing the gap versus Microsoft. You look at those Google Cloud numbers on a growth trajectory of 40, 50 billion. That's the key to, we think, $34 per share of the story. Now, I get it, the knee-jerk reaction, stocks run huge, but I actually, when I look out in the next 3, 6, 9 months, the mojo is back at Google. Not just on advertising and search, but in AI. And from an AI cloud perspective, that's key to the sum of the parts valuation here. And that's why I think it's very easy to get caught up, and this is how we've handled investors last year and a half. As soon as tech sells off, that's it, alarm. But it is 9 p.m. in the AI party that we think goes to 4 a.m. So I get if you want to look at that from the outside. We like being in that party, and I think this plays out. It's part of our tech bull thesis.
So Alphabet's going out to get more beer for this party.
They're not even on the dance floor in the AI party.
All right, so here's my question when it comes to Alphabet. The comps get a lot harder going forward. It was already kind of hard for the second quarter, but for the second half, it gets a lot harder. So what do investors hang their hat on in the second half of the year as Alphabet continues to spend and investors don't get the payoff that they're looking for from these investments in AI?
Well, I've talked, and my colleague and I, Scott Dev, have done great work here in terms of all of our survey work showing advertising rebounds happening. You look what's happening on search, those are strong numbers. Those are drop the mic tight numbers. Now you look at YouTube, clearly around the edges, some weakness. Margins are going to continue to increase. You look at that Google Cloud, GCP, Google Cloud is key to what Kurian and the company are doing in terms of the valuation, just like we'll see from Microsoft next week, like we're going to see from Amazon. There's a cloud arms race, a Game of Thrones, a House of Dragons, whatever you want to call it. That, to me, is why I believe this continues to still be a 1995 moment, not a 1999 moment, and that's our view of tech here in handholding.
If investors woke up today after months of saying we like CapEx and say, no, this sucks now, then how do you get past the next couple of months? I mean, you look at every tech company is going to be announcing their CapEx spending. If it's tough to spend, then how do you get through it?
Look at Apple at WWDC when I'm sitting there. Stock's down 190. Everyone's disappointed. Look where it is today. What's changed? It was a digestion of investors understanding that the consumer AI revolution now goes through Cupertino. When you look at CapEx, CapEx is key to the second, third, fourth derivatives. That's how this AI revolution plays out. You look at CapEx increasing from Google, you look at what we're going to see from Amazon, Microsoft, Apple, Tesla, and others. That is positive. And that, to me, is why these dips, you own the winners. Despite many of the bears continuing to, look, they like to own value, right lane, 55 miles an hour in a minivan. I get it. But I'll pay up for the Bugatti 100 miles an hour in the left lane, and that's why we want to own tech.
NASDAQ 100 now down 3.5%. Are you more or less bullish today?
More, because you look at those numbers, there's nothing in that numbers that in any way dented the thesis. But yet right now, everyone's heading for the elevator. New York City cab drivers selling tech today. That's when you want to own it.
All right, good stuff. Dan Ives over at Wedbush remains very, very confident and very, very optimistic on the tech sector. Speaking of which, let's take a look at some of those big names in the tech sector and how they're faring today. Lots of red arrows and lots of big, big declines. Tesla, as you can see, losing 11% on the day. Disappointing quarter for the company yet again. NVIDIA, the chip maker that is basically the poster child for AI, off by more than 6%. Qualcomm, another chip maker, losing 6%. And Meta Platforms down by 5.4%. Remember, we haven't even heard from Meta or Qualcomm yet. And that'll happen in the days and weeks to come.
And the long end of the curve is selling off a little bit here, but still a strong bid in the short end. A little bit of cover that you're seeing among investors, Scar.
A little bit of safety. This is the close on Bloomberg.
The market is selling off just as it was supposed to come back. Remember, aftermarket today, you have actually the largest IPO of the year looking to price its IPO and start trading tomorrow. That is storage firm Lineage. And of course, when you look at the IPO market, it means a lot for venture capital. And just today, we reported that Sequoia Capital is leading a fundraise of $150 million for Vanta, the compliance startup now valued at $2.45 billion 2 years after its last round. Sequoia is saying the move will help accelerate the firm's work in AI, of course, the one hot space. Even that place, though, is seeing a dive today. Bloomberg's Sarah McBride has a lot more on this specific investment, on the venture capital community at large. Talk about what's happening here. Why is this a coup for Sequoia at this particular point in time?
Well, for Vanta, I'd say that this round, $150 million, is actually exactly the same as its last round 2 years ago, which was also $150 million. But this time the valuation is, as you said, $2.45 billion. So it's gone up in valuation, not a giant increase, no increase at all in the amount of funds raised. But this is the kind of slow and steady story that's the backbone of the IPO market. It's a company that does something a little bit boring, compliance software. It's perfect for AI. There are a lot of different places where it can tap AI and sell customer products. For example, it is building a feature where companies that normally have to deploy humans to fill out these really boring surveys on who has access to what pieces of software, AI can do that now. So it's just sort of perfectly positioned in this market where people need a lot of tools.
Right. I mean, I think you put it nicely when you said it's a boring company in that it's another enterprise software company, but it has that bright, shiny thing tied to AI and the promise that that can deliver. One thing that you've noted, Sarah, is whenever we talk about a startup, it's so tied to the founder of the company. And the founder of the company knows how to survive tough times. I mean, you had a story about how she spends frugally. She doesn't spend on extraneous things. How does that tie into the story that Vanta tells?
Yeah, she's actually the perfect founder for these times. Even before it became trendy to cut back on expenses, in 2021, she was already buying Costco coffee for her startup. She does things like she pared back all the messaging apps they were using, so they started using Slack only. She's constantly looking for ways to cut costs. And she has a great personal story. She went to Stanford. She was an econ major. She worked at Dropbox. While she was working at Dropbox, she noticed all these compliance questions, decided to start Vanta. She went to the famous startup incubator called Y Combinator. It's like she just followed every single step of how to be the perfect founder.
Sarah, thank you so much for your time. That is Bloomberg's Sarah McBride out with a new story just today. And coming up next, we're going to switch gears, talk to Anthony Pompliano of Pomp Investments. Stick with us for that conversation next. This is The Close on Bloomberg.
We're big believers in Bitcoin and gold. So Bitcoin is rallying. I do think Ethereum is a very different blockchain software technology. It's got, what I emphasize is the risks. It's got competitors. It had to cut prices last year to match Solana, and it's been losing market share. So Ethereum is not kind of I shouldn't say that Bitcoin is a no-brainer, but it's a very different investment proposition. And I think Bitcoin is definitely a diversifier, as are commodities and other real assets.
That was Jan van Eck, the CEO of Eck Associates, speaking to us earlier, kicking off the show and referencing the gains that we're seeing in Bitcoin today, despite the sell-off in risky assets, notably led by mega-cap tech stocks.
Right. If you think tech is selling off, then wouldn't you think Bitcoin and Ethereum would be having a worse day, too?
Ethereum is, though, right? It's down. ETHA, which is the ETF that tracks Ethereum, is off by 2.2%.
2% compared to more than 3.5% for the NASDAQ. What are we looking at here? So speaking of crypto, connoisseurs from all over the world are going to converge in Nashville tomorrow for that annual Bitcoin conference. And remember that in a show of how politics is impacting the industry, that is where former President Donald Trump is set to deliver the keynote address. We're going to talk more about this with Anthony Pompliano, founder of Pomp Investments. And first of all, there's a keynote to talk about tomorrow. There's also the reaction that you're seeing in markets. What is Bitcoin in a volatile stock market? Why isn't it seen as more of a risk asset?
Yeah, I think one of the interesting things is Bitcoin is the most certain thing in the world, right? If you actually go and you look at it, Bitcoin is computer code that is auditable by anyone in the world. And regardless of what happens in markets, whether people want more Bitcoin, less Bitcoin, whether interest rates are high, low, et cetera, the software continues to execute exactly as it's designed. The reason why that's important is it's the 180-degree difference than traditional markets, right? If you go and you look, when people want more dollars, we figure out how to put more dollars into the market. When people need more dollars, we put more dollars into the market. And so because of that certainty, what happens is in times of uncertainty or chaos, people flock to Bitcoin. And so you can see this over the last 2 weekends where we had political instability or political kind of chaos, people flocked to Bitcoin, Bitcoin's price went up. And so I think that certainty ends up being something on a global basis that people are starting to familiarize themselves with and put capital into.
So speaking of politics, Donald Trump is, of course, speaking at this conference. We have another person on later, Anthony Scaramucci, of course, big buyer of Bitcoin, who says Kamala Harris is just as good for Bitcoin. Is Trump really the pro-crypto candidate?
I actually don't think it matters in terms of who is going to do what for Bitcoin or crypto. I think what is more important is that there is one side of the political aisle at the moment that realizes that this is a really important point for 50 plus million Americans. And so whether you call it pandering to them or they're actually going to do it, you're not going to know that till after the election, right? And so one of the interesting things is Donald Trump is positioning himself as the pro-Bitcoin, pro-crypto candidate for sure. I think what the Democrats have to decide is, are you going to cede that point to Donald Trump? Are you going to say, hey, you get to be the pro-Bitcoin, pro-crypto candidate, and we're going to be the anti? I think actually what would be better for them and kind of the game theory that Bitcoiners have talked about for a long time is, no, you should just become pro-Bitcoin, pro-crypto as well, and therefore you take away that advantage that he has with that voter base. And so we've seen this at the state and local level, right? We've seen states compete over these people. I do think it will come to national politics, and my expectation is that whoever gets into the White House will end up being pro-Bitcoin, pro-crypto, because this is such a large voter base now that they're going to have to cater to them.
I really, really like that point you just made. And we actually asked the CEO of Ripple about that. He attended the RNC, notably. He's also going to attend the DNC. Here's what he had to say about politics and Bitcoin.
This should have never really become a partisan issue. I think all of us should embrace technical innovation. And these are technologies that truly can transform the cost and efficiency of financial transactions particularly. And so our message is really that we as an industry want to be regulated. We want to have the clarity of that regulation.
We as an industry want to be regulated. Is that something that the industry wants? I mean, when people are attending this Bitcoin conference, how many people? 30,000?
Oh, there's going to be a lot. Yeah,
okay.
Tens of thousands for sure.
Tens of thousands of people. They want regulation?
I think that everyone who operates a business wants to understand what are the rules, right? One of the beauties of America is in a capitalistic society, it's all about competition. Let me compete. But in order to compete, you need to know what those rules are. And so there's two schools of thoughts on this. Some people say, hey, look, all the existing rules already apply here and we don't need to change anything. But think about decentralization as an example. If you have a decentralized organization, how do you regulate that? What are the rules if you're the developer that's going to create that technology? So there's a lot of unanswered questions. I think that's where people are saying, tell us what the rules are, let us go compete. Now, what I do think is also really important is some other countries have rules in place. We may not agree with them or we may like them, but if other places get clarity and we don't have the clarity, now all of a sudden they have an advantage because entrepreneurs in those jurisdictions can go and compete before us.
Right, and they've set the standard in many ways, right?
Well, the other thing, too, you just formed a new investment company. You invest in crypto, but you invest outside of crypto as well. What are you doing on a day like today?
Yeah, so I tend to be very long-term oriented. I don't really like to trade anything in the short term.
Are you buying the dip?
So with crypto, we usually will buy the dip. We'll buy Bitcoin. We've been buying Solana over the last year or so. And really the thought process there is like, over the next 5 to 10 years, there's one major theme. If you get it right in finance, you're going to make money. If you miss the theme, you're going to be on the wrong side of the trade, which is the dollar is going to be devalued. We have seen the national debt go up with Republicans and Democrats both in office. The Congress, Senate, and whoever's leading the presidential seat, they have to continue to devalue that dollar. And so naturally, getting into investments and holding for the long term, you should do pretty well. And so I think that people try to make things a little bit too complicated. They're trying to pick individual stocks, et cetera. The United States of America does a fantastic job of giving us access to capital markets. Put your money to work, shut up, sit down, sit on your hands, don't touch it, and just let the asset prices go up. And so when you see that happening, whether it's crypto or stocks, really all you're asking yourself is how much volatility can I stomach, right? Both of them are going to go up over the long run because you're going to get a devalued dollar. The question is, can you sit there and see something draw down 60, 70, 80% and be okay? There's a lot of people who are sitting at home saying, I can't do that, so they should probably go in the stock market. But there's a lot of people who say, you know what, I'm fine with that. And those are the people who are going to go and buy these crypto assets.
The election is right around the corner. Again, you just started a new firm. You may want to be putting money in new stocks. Do you think that there's a lot more volatility headed into the election? Do you wait for a minute so you don't stomach that volatility?
The data definitely suggests that we get more volatility in the second half of election years. So I think that we would be dumb to kind of fight that trend. And I do think that we'll continue to see that volatility, especially if you just look, we're only in the month of July and we've already had assassination attempts. We've seen the president candidate drop out, et cetera. But I also think that asset prices end up not really being affected by presidents as much as people would like to say, right? So if you go and you talk to Republicans, they'll tell you how bad of a job Joe Biden's done. Stock market's at all-time highs. Under President Trump, people were yelling and screaming about how bad of a job he was doing. Stock market was at all-time highs. And so I really do think that the president matters for a lot of different policies. Leadership matters. But when it comes to asset prices, the market tends to be much more insulated than people would like to assume.
So, Anthony, you're going to head over to Nashville and attend the Bitcoin conference. Your number one prediction for what news we're going to get out of it?
Yeah.
This conference tends to make news.
Definitely makes news. So one of the themes over the last couple of years has been people have gone there and specifically nation states have said, El Salvador being the first one, hey, we are going to embrace this asset. There's this rumor that Donald Trump is going to call for a national strategic reserve of Bitcoin for the United States. What's interesting about that is if you call for it before you actually go do it, you're probably going to, as a country, buy Bitcoin at a higher price than before if you had bought it and then announced it. But I do think that the United States at some point is going to create a national strategic reserve of Bitcoin. I do think that Donald Trump is likely to be one of the candidates, if not the candidate, to push that forward. And once one says it, I think that not only will you get that to become a popular narrative throughout all of U.S. politics, you also will see many other countries start talking about it as well.
All right, good stuff. But again, we have to be cautious of putting the cart before the horse as well. Anthony Pompliano, thank you so much, founder of Pomp Investments. And of course, you mentioned that former President Trump delivering the keynote at the Bitcoin conference. Trump is holding a private fundraising effort kind of on the sidelines, and the asking price for a ticket to attend this event $844,600 for a seat at a round table.
It's pretty expensive to get to this Bitcoin conference as well. It is costly to get a seat next to Donald Trump, apparently. But yes, this is a fundraiser, of course, in early August. Howard Lutnick, the CEO of Cantor Fitzgerald, also very pro-crypto CEO, is one of the main people putting this together. But of course, we will keep an eye on that, as well as all the fundraising efforts, all the big dollars coming out for both Kamala Harris, we'll talk a little more about that later, and Donald Trump.
You know, if you want just a photo op, $60,000 per person, so slightly less than the one price of Bitcoin. All right, there you go. Coming up, we've got shares of Lamb Weston sinking the most on record. We've got more on the grim outlook from the frozen potatoes brand in today's Stock of the Hour. This is The Close on Bloomberg. Time now for the Stock of the Hour, and today we're watching shares of Lamb Weston, the frozen French fry maker's stock falling the most on record. The CEO saying global restaurant traffic and frozen potato demand have softened due to inflation, and they expect a challenging year ahead. Bloomberg's Abigail Doolittle has more. So McDonald's and its $5 value meals are doing really well, but frozen French fries are not selling well?
Yeah, this is a head scratcher. I mean, just the idea that you could have a potato company miss earnings by 38%. I mean, if ever there was a market that you would think that there would be visibility on, it would be potatoes, McDonald's, restaurants, frozen potatoes at grocery stores, but that's not the case. The stock absolutely plunging because of this miss. Again, missing earnings by 38%, revenues by 5%. The 2025 guide is also below. So yes, they are saying that it has to do with restaurant weakness. That's just a piece of the pie, though. I was looking, you know, like retail was actually more than restaurant. Then there's the global restaurant. They're talking about menu price inflation. So the top line miss, and it could be that potato is a lot of that. That doesn't really help to explain the earnings. I think that I think that there's just holes here.
Is it just hard to sell potatoes in an Ozempic world?
That's an interesting question, Shanali. That's a very interesting question. I don't know. That would be a good question to ask their management team, because it seems to me that on a menu, if there's price inflation, potato would be the one thing that restaurants would try to push in there to offset that. So maybe that is a point.
I'm still eating potatoes.
Me too.
That's really interesting. But what's also notable here is that McDonald's shares are declining. Granted, the overall market is lower, but as a consumer staple, you would expect that people would find some safety in a company like McDonald's, which is doing well overall with its extra value meals.
Well, McDonald's is the world's biggest consumer of potatoes.
Yes.
I mean, McDonald's is the world's biggest consumer of apples, which when's the last time you had a McDonald's apple pie? Yeah. So I think that there is probably, they're trying to make that read through. One thing I would say is our restaurant analyst here at Bloomberg Intelligence, Michael Halen, he does not cover this company, but he's had a very good call on restaurants. People had been a little bit more positive on restaurants with a 3.1% year over year comp. He for a while has been saying, no, that's not the case. It's going to be a little bit tougher. So I think that this probably does vindicate that view, but still the earnings miss, the degree of the mismatch between the earnings miss and the revenue miss doesn't make quite sense. And then if we bring in the consumer, there's a lot of people online saying this is a sign that the consumer is weak. They don't have money to spend. But again, it's potatoes.
You always have room to spend on French fries.
Yes, sorry, and potato chips.
It's a very affordable luxury. Abigail, thank you so much. And I'm so glad you asked about the Ozempic question. You know, but yesterday we were talking about how Cal-Maine, which is an egg supplier, has also saw fourth quarter EPS misestimates. And eggs are full of protein. I know there's a cholesterol issue, but a lot of people are cutting back on things like fries in favor of things with higher protein, like eggs.
It's fascinating, too. You see the divergence pretty interestingly. I'm wondering if this is a sector dynamic or if there are pair trades here. Coca-Cola was a positive. Pepsi was a little weak. That is something Katie Greifeld loves to point out in this current quarter. But again, Domino's led a sell-off in pizza stocks, if you remember.
Yeah, New York Pizza did not sell well there at all. All right, coming up, we're counting down to the closing bells with Shelby McFaddin over at Motley Fool Asset Management. This is The Close. This is the countdown to the close. I'm Scarlett Fu.
And I'm Shanali Bassick. Scar, we're looking at a pretty tough tape out there. Remember, it started this morning after we saw that number from Tesla last night and Alphabet as well. And you have seen really losses quicken throughout the day. The S&P 500 now down about 2.3%. NASDAQ 100 down 3.3%. On an intraday period, you're looking at the worst tape on the NASDAQ 100 since the end of 2022. The Philadelphia Semiconductor Index dropping even harder at 4.6%. The Russell 2000, you are not getting any Haven bid there either, 1.8% lower heading into the close.
But notably, it is performing better than the other major big cap indexes. It's falling less than the others. It is down, of course, to be fair. So let's bring in Shelby McFaddin. She's the senior analyst at Motley Fool Asset Management for her take on this sell-off that we're seeing. It's a pretty steady decline through the trading day. We've seen the S&P 500 fall down more than 2% at the top of the hour, and it's extended those losses, but nothing too disorderly. Is this reaction justified given the results that we did see from Alphabet and Tesla?
I think so, and I think it's just a sort of example of the temperance that you're seeing investors display, because what's going to cause the sell-offs is the selling. The investors have to go ahead and make that decision that they have all of the information that they need to make this conclusion, and I think that we're just a little bit too early in earnings season, even in tech earnings, for the sort of mass of investors to say, you know what, we're done here. So I think that 2% is actually pretty appropriate, given the fact that maybe they're starting to come out of those mega large caps and rotate elsewhere.
So that rotation that you mentioned, rotate elsewhere for a while is into small caps, and you could argue that small caps are doing better than the big caps. Does that continue? Are the conditions, the economic conditions, supportive of further outperformance in small caps?
I think if we do get that lowering of rates, then yes, we will likely see a more favorable environment for small caps to continue. There are also those groups of small caps that have been able to thrive fundamentally, even in this economic environment. It's just that when we look at their pricing action, they're struggling a little bit because lower trading volume and just the sentiment around small caps in general. But there is also that opportunity for rotation back into some of the mature large caps that have just been unloved. Some of those dividend yielders, companies that have not changed in how successful they are, but they're just not high flyers when it comes to growth.
Speaking of, you gotta love what the gainers in the S&P 500 actually look like right now. It is industrials, healthcare, energy, even some consumer staples. When you think about the pain you're seeing today, you saw more earnings pain than just Google and Tesla, or at least as investors have perceived it. Lamb Weston right now, the worst performer on the S&P 500. Visa came in with a tougher tape than expected. How worried are you about the consumer in the cycle?
You know, I think it's interesting because when we think about the consumer themselves versus the companies that are exposed to them, I think the consumer is a bit more resilient. At this point, we've shaken out a lot of the households where there's a lot of debt that's preventing them from doing anything. And we've seen in some of the previous reports from card issuers and the like that people are just using things like credit cards less. So they are figuring out how to find a sustainable level of spending. Then when we want to look at consumer companies, a lot of that just sort of depends on how they've been managing their operating expenses and how they're able to lever. So I think it's a little bit of a case-by-case basis, but on the whole, I'm not seeing anything drastically negative on the forefront.
And, you know, we were talking a little bit about where people are actually buying right now. When you think about this rotation, we've been talking about it so much in terms of those small and mid caps. What about just different sectors? My goodness, like, do you take this moment and just take money out of tech and put it into utilities, into energy?
Sure. You know, as a team, we look less at sort of sectors and industries and look more at the holistic picture of quality. So we want to take cash out of places that are not generating cash flow in all parts of the cycle and make sure that we are allocating them to places that are. So in this situation, we love to see this sort of small cap rotation because we had identified lots of companies in our small cap portfolio that were cash generative, competitive, but just getting punished. And so instead of saying, you know, let's come into industrials, it's how do we feel about the pricing, the valuation of the industrials currently in our portfolio? And how do we feel about their competitive position? Is it worth going ahead and adding more to it? Or do we need to look at the geopolitical and macroeconomic landscape and say, let's change our allocation?
And these are questions that investors ask when the market's up, when the market's down. And the answer shouldn't change that much depending on any given day. However, we have now seen tech stocks really get taken out ever since that June CPI report, really raise new questions about what's next and how much more leg does this tech rally have. How does the start of this earnings season, the not so great results from Tesla and Alphabet, change the tone and change the expectations for the rest of earnings season?
Mm-hmm. I think what it shows is that there's more out there. I think it shows that there's more in the large cap market beyond what seems to be the only option when the market is a little bit precarious. So there's been so much latching on to the premiums that have been associated with tech and AI. And I think we're seeing now that some of the promises don't crystallize, and some of the growth ramps are not as steep as we thought. They're not 45 degrees, they're 15. And so investors are realizing that there is somewhere else to go. And I think that it doesn't necessarily change the narrative about how positive one can feel about the overall market, all of the indices. But if you have primary exposure to, say, the S&P 500, it is going to change your immediate future.
So some of the places that people can go, you still like a couple of names within the tech space. And I'm looking at Salesforce, for instance, CRM, currently down 2.7%. But there is something to this company that goes beyond AI.
Yes, and that's the fact that whether it's good times or bad, companies really need to have that front and back office connection. If you want to grow your business in an expansionary period, you need a Salesforce. If you need to maintain your business and hold on to your customers in a time where their own budgets are tight, they need you, they want you. And when you look at their scale, they're able to do that, to move around their pricing and be competitive in a way that smaller companies maybe might not excel at to the same degree. So we appreciate that. And considering they've also listened to shareholders when it was there's overinvestment, this is not a good use of capital, they are appreciating what shareholders are asking from them. And they're starting to approach business as a mature company. And I think that the market has rewarded them for that.
Good stuff. Thank you so much for joining us. Really appreciate it.
Of course.
Shelby McFaddin is a senior analyst at Motley Full Asset Management, joining us on this day in which you have the major indexes all in the red. The S&P 500 losing more than 2%. The NASDAQ down by 3.6%. Even the Russell 2000, which has done better than most, now joining the down 2% club. And Shanali, looking at some technicals, the S&P 500 now just below its 200-day moving average as well. And I mean, that's a stark contrast to where it was at the start of the day.
I'm looking for divergence in the market here because, you know, it's interesting. You think Tesla's dragging everything down. It's actually Trade Desk that's the second biggest decliner on the NASDAQ 100. That is a company that is very closely tied to the digital advertising world. You have ripple effects when the giants, the Mag 7, start to report numbers that the market doesn't like. Let's see how that turns around. For Trade Desk, for example, Morgan Stanley just raised the price target. So there is divergence in this market.
All right, we're looking at Tesla down 12% on the day, Nvidia off by 6.8%, Microsoft losing 3.7%, Alphabet losing more than 5%, and of course, we've got more earnings to come as we await the closing bell. Full market coverage right here on Bloomberg.
The Closing Bell, Bloomberg's comprehensive cross-platform coverage of the U.S. market close, starts right now.
We're about 2 minutes away from the end of the trading day. Scarlett Fu and Shanali Basak here with you, and here to help us take you through the closing bell is a global simulcast, Carol Masser and Tim Stenovic. Welcome to our Bloomberg Radio and YouTube audiences, in addition to our Bloomberg Television audiences. Carol, down on the day. The Russell 2000 now joining the S&P and the NASDAQ and falling more than 2%. So at least in equities, it's hard to find a place to hide today.
Yeah, that's really fair. And I think it's been interesting just to watch the last few minutes of trading taking another leg down. So pretty much at our worst levels of the session. Having said that, you know, some of the safer plays like utilities, you are seeing some gains. You can see kind of the tone among investors and where they want to kind of hide in this market. But not, you know, we got a little bit of green out there.
Yeah, a little bit of green. And it was interesting because we saw the Russell or green earlier in the session. But like you said, Scarlett, it's not just a rotation like we saw, you know, in recent trading days where a sell-off in mega cap tech moves into smaller companies. No, everything across the indices is lower today. Certainly, Shanali, the two mega cap tech companies that we heard from yesterday, two of the seven magnificent seven, Tesla and Google, not necessarily sending a great signal or tone, at least at the start of this earnings season.
Listen, the reason the sell-off is painful is because you had a lot of investors hiding out in so few names, and you have to wonder with the sell-off that they're seeing like today, what does a dry powder look like to reinvest, to be a part of that rotation trade? You have to bet on that cash on the sidelines to get into it.
Or do you wait and see how this all shakes out before you commit new money to new positions, right? You hear the closing bells right now. We're about 9 seconds away from the end of the trading day, and we are looking like we're going to close at our session lows, Carol. The S&P 500 down about 2.3% on the day. The Dow Industrials losing 1.25%. The NASDAQ, the worst of the bunch, losing more than 3.5%. Again, these are the biggest declines since late 2022. And the Russell 2000 not escaping either, also closing at its session lows, off by 2.1%.
Yeah, absolutely. As we said, a little bit of a leg down towards these last few minutes and just bouncing off of it. Having said that, Scarlett, if I look at the S&P 500, yep, most names are lower, folks, 337 to be exact. But we did see 166 names actually higher in the S&P 500 today. So not everything was completely down, but certainly the majority of the names.
The majority of the names are certainly down, but you look at the IMAP, which breaks down the S&P 500 into 11 main sectors, and the sectors that are higher, utilities, up by more than 1%, 1.2% gain. Of course, one of the smallest sectors in the index, right? Healthcare gaining 0.8%. These are the dividend payers, the reliable companies. Energy up by 0.2%. And staples basically unchanged, but tech is the big loser on the day, off by more than 4%.
All right, so let's get to some of the individual gainers. We just talked with Mattel CEO Ynon Kreiz. They had a banner day, certainly one for the bulls, up almost 10% in today's session, rallying on heavy volume. The company reported second quarter adjusted EPS that came in ahead of estimates. Analysts were positive on the results, highlighting the company's gross margin performance, which Morgan Stanley said had remained impressive. We know on Monday there was a report that Mattel had received a takeover approach from L. Catterton, the PE firm backed by LVMH. We pressed the CEO, said that they still believe the best shareholder value is going it alone. So anyway, Mattel a standout. Enphase Energy, folks, number one gainer in the S&P 500, up almost 13% in today's session. Maker, of course, of solar equipment, reported second quarter gross margin higher than estimates. Truist Securities said third quarter guidance, while below consensus estimates, should give investors some confidence. So go figure. CoStar Group, also an outperformer, at its highs up 9% in today's session, finishing the day with a gain of just shy of 2%. It was among some of the top gainers in the S&P and NASDAQ 100, again on heavy volume. It's a real estate information and analytics company, services company, reported EPS above estimates and sales in line with estimates. Forecast for sales profit did miss estimates and analysts did lower price targets, but nonetheless, investors found some reasons to buy. And so you did see a couple of names certainly fundamentally driven or earnings driven in today's session.
Okay, people were buying those stocks, Carol. People were, well, I guess everyone's buying and selling all the time, but the selling pressure was on for these other ones. I want to start with Tesla. Shares falling more than 12% today, the biggest drop since September of 2020. This after the company reported another quarter of disappointing profit and postponed that highly anticipated unveiling of autonomous taxis. The volatile stock plunging the most in almost 6 months. Shares again dropping the most since September of 2020. And then also a huge decliner when it comes to weighing on the NASDAQ 100, the NASDAQ Composite, and the S&P 500 is the parent company of Google, that is Alphabet. Shares fell after the company spent more resources into its drive to outmatch rivals in AI, fueling spending higher than analysts expected. CapEx spending came in higher than analysts thought it would. They thought it would be at $12.2 billion. It came in at $13.2 billion. And then YouTube revenue also came in below what analysts had estimated. Google shares finishing the day down by more than 5%. Alphabet, I should say. NVIDIA shares fell after Elon Musk said on Tesla's earnings call yesterday that Tesla will, quote, double down on its Dojo supercomputer project because of high demand for those NVIDIA chips. Elon Musk said he's concerned about being able to get an adequate supply of NVIDIA chips and that Dojo can be competitive with NVIDIA. Shares in NVIDIA dropping more than 6% today. And finally, let's talk potatoes. Lamb Weston down more than 28%. Its biggest single-day decline on record. This after the company reported adjusted earnings per share and EBITDA for the fourth quarter that missed the average analyst estimate. Profit guidance for fiscal 2025 is also below consensus. You had a handful of analysts come out, including Vital Knowledge, who called the earnings report and guidance, quote, disastrous.
You know, Janelle made a really, really good point, which is how much of that is tied to Ozempic and people not wanting to eat French fries right now as they try to lose weight.
You always have to eat French fries. I'm just going to put it out there.
You know, if you're worried about the consumer, there was another place that there was a haven bid today, guys, and that was the bond market. Let's take a look at yields and how they've performed, because the 2-year really saw a significant decline. That was off the heels this morning, of course. Bill Dudley, formerly of the New York Fed here, speaking about the idea of a rate cut needed as early as next week at next week's FOMC meeting, driving yields much lower in the short end of the curve. You did not see the same at the long end. You saw yields higher as you went along, 5-year, 10-year, 5 years flat. But 10-year was 3 basis points higher, 20-year 5 basis points. That bear steepen are in full effect.
All right, folks, we do have some earnings crossing. Just got one headline so far in terms of Ford. Ford's second quarter adjusted EPS coming in at 47 cents a share. That looks like it is 20 cents light. We know Ford, very interesting as we see, General Motors, some concerns about the EV space. We did see GM boosting its profit outlook for the year, so we're waiting for some outlook from Ford Motor. And we're looking at Ford right now down about 2% here in the aftermarket.
Yeah, we're going to be joined by Steve Mann from Bloomberg Intelligence in just a few minutes on our program going through these results. Still only have one headline. Second quarter adjusted earnings per share coming in 20 cents below estimates, 47 cents versus estimates of 67 cents. Not seeing the stock move too much in the after hours. I guess I spoke too soon because now it's down 2.3%. But Carol mentioned the context of what we heard from GM yesterday. So certainly looking out for investments in the traditional auto business, the ICE business, versus what's going on when it comes to progress in EVs.
Okay, we also have a headline here on its outlook. Ford still sees full year adjusted EBIT of $10 billion to $12 billion. Analysts were looking for $11.23 billion. So the midpoint of that range is slightly below what analysts were anticipating. But the press release makes it clear that Ford is on track for 2024 profitability. It also raises its cash flow outlook. I don't have the details on the cash flow outlook, but it goes back to that idea of what you were saying, Tim, about the ICE business doing much better than the EV side.
Listen, you're bringing in $47.8 billion of second quarter revenue, Ford is saying here as well. Yeah. And remember, adjusted revenue was supposed to be about $44 billion. The EPS was a significant miss, though, as we were saying, 20 cents. And just take a look at that stock, dropping down more than 6% after hours. So really feeling that earnings miss in particular. We will be speaking to Ford a little bit later in this show as well to talk a little bit more about these transitions.
You mentioned the free cash flow. So as you said, expectations for full year 2024 adjusted EBIT unchanged at 10 to 12 billion. Adjusted free cash flow outlook raised $1 billion to between $7.5 billion and $8.5 billion. So just looking at the press release as it is crossing.
Okay, so two different segments, Ford Blue and Ford Model E. Ford Blue revenue, the traditional business, coming in above estimates at $26.7 billion for the second quarter versus estimates of $25.63 billion. Ford Model E revenue, that's the new electric business, coming in at $1.1 billion. That was below estimates of $1.31 billion.
Okay.
Ford shares down 7.5% right now. More than 7.5%.
Let's also give you the outlook for Ford Pro, which is its business that covers commercial fleet vehicles as well as services. For the full year, Ford Pro EBIT of $9 billion to $10 billion is the forecast. It had seen previously $8 billion to $9 billion, so that is an increase in its guidance for the Ford Pro business, which of course is less significant than the Ford Blue business, which has done well.
All right, quick headline, guys. IBM crossing second quarter revenue that is $15.77 billion versus an estimate of $15.61 billion. So just a little bit to the upside, and you've got just a quick reaction in IBM shares in the aftermarket, up 2.1%. All right, guys, we're going to continue to watch more earnings to come. That is a wrap. Our cross-platform coverage, radio, TV, YouTube. We call it the closing bell. We'll see you again, same time, same place tomorrow.
All right, we have a handful of earnings here that we're still looking through, and we will give you some more market analysis and earnings analysis next. This is The Close on Bloomberg. Welcome back to The Close. I'm Scarlett Fu.
And I'm Sonali Basak. We're taking a look at a significant set of earnings crossing the wire right now, causing stocks to move significantly after market, Scar.
Yeah, let's start with Chipotle. The shares are rising in after-hours trade, now up by 6.6%. Second quarter comparable sales rising 11.1%. Analysts were looking for a gain of 9.2%. So that is a beat on comparable sales. And as a result, the revenue line for Chipotle in the second quarter, $3 billion even. Analysts were looking for 2.94. In terms of the bottom line, adjusted EPS of 34 cents does top the average analyst estimate by 2 pennies. In terms of commentary, Chipotle says it still sees full-year new restaurants of 285 to 315. Analysts were looking for just over 306. So Chipotle is still moving forward with its expansion plans here. Operating margin, Sonali, for the second quarter, 19.7%. Analysts were looking for 19.2%.
Also want to look at another up arrow story here. ServiceNow boosting full-year subscription revenue as we we see their report after the close here, they're going to make strategic growth investments. As according to their report, you have ServiceNow rising more than 1% after market. ServiceNow also saying their COO resigned after a probe into hiring of a former Army executive, but the stock really shaking off that resignation here to focus on the earnings itself.
Okay, another stock that is moving higher in after-hours trading is IBM, and this is on an AI narrative here. IBM reports a boost in AI bookings and better-than-expected revenue in the second quarter. $15.77 billion was the top-line number for the second quarter. Analysts were looking for $15.6 billion, and generative AI book that at IBM has grown to over $2 billion since the launch of Watson X. So IBM really touting its AI capabilities on a day when AI disappointment had dragged much of the broader market, notably two of the Magnificent Seven that reported much, much lower. So again, IBM coming in with a better than expected revenue number that did impress investors, and the stock currently up by more than 4%.
I also want to go back to talk a little bit more about what we saw out of Ford. Ford, of course, now dropping pretty significantly after market, seeing losses after market in the stock of as much as 10%. So they came in with adjusted earnings per share of 47 cents. That is a 20-cent miss that we are seeing. Across business lines here, we're seeing divergences. We're seeing Ford Blue revenue coming in above estimates. We're seeing Model E revenue coming in below estimates. And we're seeing Ford Pro revenue above estimates. So a very significant move here. Of course, the auto market in and of itself between GM and Tesla, a lot of eyes on this industry right now. Let's take a little more of a look here throughout some of the other metrics we were talking about with Ford. Their CapEx spending is seen to be the same at $8 to $9 billion, Scarlett.
Yeah, and it just speaks to this idea of perhaps that miss on the Ford Model E, which is the electric vehicles, is really what might be driving the earnings miss. So let's bring in now Ford CFO John Lawler to give us more of a read on what happened over at Ford. John, thank you so much for joining us. Let's start with the EPS line, which was a miss of 20 cents compared with the consensus. Can you walk us through what dragged the EPS lower to miss estimates by that much?
Well, look, we reaffirmed guidance for the year, our adjusted EBIT guidance between 10 and 12 billion. We increased our free cash flow guidance by $1 billion. This is one quarter along the journey towards reshaping the company as we transform, as the industry transforms, and it's not going to be a straight line up. But I think the positive here is that we're on track for the year, consistent with what we said at the beginning of the year, and our cash flow is coming in better. So, we're moving forward, fixing the business, reshaping the company, and really leaning into the strengths we have with Ford Pro and with Ford Blue, and really driving increased sales in our electric business with our hybrid sales, up 34% this quarter, 9% of our mix. So we're seeing strengths in many different areas across the business, but again, full year, we're on track.
Full year, you're on track. I know that in the past, Ford has projected EV losses of up to $5.5 billion this year. At what point will Ford make profit on EVs?
Well, in the quarter, you saw that we reduced our costs in our EV business in Ford Model E. We're working towards profitability with our second-gen vehicles, which will be ground up, all new platforms that we're developing. And, we won't launch those vehicles unless they are profitable in the first year of sales. So that's what we're focused on right now, fixing that business, lowering the costs until our second-generation vehicles come out, and continuing to drive, positive performance across both Blue and Pro.
So how do you feel about the EV story overall? I'm sure, John, you can appreciate a lot of people are focused on this transition here and what it means for you guys. Think about just the Oakville, Ontario plant, for example, the focusing on Super Duty pickups instead of EVs. How much is Ford backing off of EVs?
Look, we are committed to EVs. It's not a matter of if, they're going to happen. We have tremendous demand for our Super Duty vehicles. We can't meet customers' needs. So we took a plant that's available in Ontario. We converted it over. We're converting it over to Super Duty to fit a need. It's going to be capital efficient. It's the quickest plant and path to bring more Super Duties to market. And then, we'll reaffirm later where we're going to build our SUV that was planned for the Ontario plant. So we're still committed to our electric vehicle business. It is the future. The path there is just going to be different than what many people perceived or thought a few months ago, a few years ago. But, we're not giving up on EVs. They're an important part of our business. They're an important part of our future.
When you look at the numbers here, it seems like there are certain factors, warranties, for example, that might have been a big factor in this earnings per share beat. John, I can also appreciate that you're looking to guide toward the future here, but what was the biggest contributor here to the EPS miss? What are you telling investors?
Well, I think warranty did come in higher than we had planned, and that was for models that were engineered and launched before 2021 model years. What you're seeing, though, is that our quality is improving. If you look at the J.D. Power initial survey on quality, we moved from 23 up to number 9. Now, are we happy with number 9? No. We have a lot of work to do, but we're really focused on improving quality. We're seeing it in our internal numbers, and you're seeing it validated from third parties. So that's the important thing. And then over time, that will start to show up through lower warranty costs as those quality numbers come through our consumers and come through our products we're launching in the markets today.
I'm looking at the Ford Blue business, which is your ICE business, and on a revenue line, it looks like it did better than expected. But when it comes to EBIT, $1.17 billion compares with the estimate of $2.43 billion. What happened to account for that big miss on the EBIT line for Ford Blue?
Two things in there. One, most of the warranty increase was in Ford Blue. The other thing is, in the first half, second quarter, and in the first half, we were launching a number of vehicles, and with those launches came higher costs. Now, in the second half, we expect Ford Blue to do much better than they did in the first half. We'll have a new F-Series in the marketplace running at full capacity. We have the launch of the new Explorer. We have the Ranger, and then we've increased capacity on our Bronco. So second half for Ford Blue will be much stronger than the first half because we'll be through all these launches and we'll have a lot more product in the marketplace, and those are very profitable products for us in our lineup.
Okay, so the warranty impact, it sounds like, John, was a one-time thing, not something that will be recurring. What does this mean in terms of how you're looking at your costs? Will there be more significant cost cuts?
Yeah, we're working on reducing our costs intensely. It's an incredible focus by the team. Really, it's a quality and cost reductions. That's our opportunity in the near term to really improve the business. The team's focused on it. There will be additional cost reductions. We're on track to take $2 billion in material cost out, manufacturing costs, freight costs, and we're going to look to, accelerate that progress.
At the end of the day, has Ford Pro become the most important part of your business with all things considered?
I think all parts of the business are important. Our incredible ICE platform is going to be here for a long time. EVs are going to be a big part of our future. But yeah, Ford Pro is different. It is a very strong part of our business. It's unmatched in the industry with the strengths we have. It's the culmination of hardware, software, and services coming together. It's an accretive business that's going to, drive the bottom line for Ford Motor Company over the next several years for sure. We increased our guidance for Ford Pro for the year, adjusted EBIT guidance by $1 billion. So yeah, it's a special business within Ford, and we're really pleased with how it's performing.
John, we really appreciate your time today. Of course, that is Ford CFO John Lawler, right on the heels of an important earnings season. Now, I want to bring you also some breaking news from Bank of America, increasing its common stock dividend 8% to 26 cents per share. Also, importantly, authorizing a $25 billion stock repurchase program. Those are those banks, Scarlett, giving back money. Bank of America now up 0.6% after market.
It's curious that they did it now because the stress test results came out a few weeks ago. Why did they wait so long, do you think?
It's a while to get to the system, But also, they just had earnings come out as well, too, and they were guiding net interest income higher as well.
All right. Coming up, we're going to stick with earnings. We're going to break down results from Chipotle next. This is The Close on Bloomberg. All right, we have a headline here that the NBA says it has entered into a long-term arrangement with Amazon and that Warner Brothers Discovery did not match the terms of Amazon's offer. Remember, Warner Brothers Discovery was trying to match Amazon's bid for NBA's TV rights, the NBA's TV rights for the next round. And it was part of a clause in its expiring contract with the league that it could kind of match. But at this point, it appears that the NBA has said no thank you to Warner Brothers, and perhaps that puts Warner Brothers out as a media partner here for the NBA, which is pretty incredible given that the program that Warner Brothers runs inside the NBA is one of the most popular and is kind of synonymous with broadcasting of NBA games overall. Amazon shares, as you can see, currently up 0.6%. Warner Brothers Discovery down 0.5%. And Disney, which runs ESPN, and Comcast, which runs NBC, are the other partners in this new $76 billion 11-year deal that the NBA is on the verge of signing.
And absolutely. You're seeing, of course, sports being the next vantage point, the next forefront, really, of streaming here, and Amazon shares really reacting after market. Warner Brothers Discovery down 0.5% on losing this deal. So we will keep bringing you more as we know it of this very highly watched deal in the streaming world that we've been keeping an eye on.
And of course, we're also keeping an eye on earnings. Lots of earnings have rolled in, and one that we're focused on right now is Chipotle, notable for the big gain in the stock in after hours, up almost 13% at the moment after Chipotle beat market expectations on robust diner traffic. Let's bring in now Michael Halen of Bloomberg Intelligence to give us a little bit more here. What did Chipotle do to be able to drive traffic into its stores? Was it limited special time offers, or was it a kind of a fundamental rethink here?
No, it's more of the same. Strong digital business, LTOs, chicken LTO, they pointed out, did really well in the quarter. They do a great job, right? Their to-go business is still pretty strong post-pandemic. Marketing, they do a great job on the marketing side. So yeah, Chipotle's, rung up another great quarter, and I think investors are very relieved that they didn't get kind of, they haven't yet seen a slowdown that we're starting to see kind of industry wide, and so I think that's part of the reason you're seeing the pop in the shares right now.
Right, Michael. At what point does that catch up to them? You had McDonald's saying they're extending their $5 meal deal today. They had a tough day along with a lot of other stocks. But does Chipotle have some immunity from the industry's problems?
Well, they really aren't serving low-income consumers, and that has been the biggest pressure point on restaurant sales this year, and even in the second half of last year. And so, because of that reason, Chipotle is insulated to some degree. I think what we're seeing right now is even weaker results in July than we saw in the second quarter. And so, that could be causing some concern that this could be spreading to middle-income consumers. And I think that's why you're seeing restaurant stocks perform so badly over the last couple months. But, largely Chipotle is insulated because of their, higher income consumer customers.
Michael Halen of Bloomberg Intelligence, we thank you so very much for keeping an eye on Chipotle, on the sector for us. Of course, Chipotle shares up after market. We're going to stick much more with earnings because it's been a very divergent quarter. Some stocks moving after market, ServiceNow being one of them, IBM being another one, staving off some of those woes in the tech market. We're going to talk more about it all next, aren't we?
Las Vegas Sands down 4%. We'll get to that as well. Roundup of your second quarter results coming up. This is The Close on Bloomberg. We want to return now to that breaking news. Bloomberg has learned that the NBA has entered into a long-term arrangement with Amazon Prime after Warner Brothers Discovery's most recent proposal for NBA media rights did not match the terms of Amazon's offer. Randall Williams is here now with more. So, Randall, this means that after this upcoming season, Warner Brothers Discovery is no longer in the business of broadcasting NBA games?
That's true. Inside the NBA is done after this season.
That is stunning. Why did it wait until this point anyway to try to match Amazon's offer? Don't you win media rights by bidding the most money?
Exactly. So if you remember the previous deal, Warner Brothers Discovery had the B block. Now there was some negotiating as far as what the official price was that Warner Brothers Discovery wanted to pay that NBC ended up getting, which was $2.5 billion a season. Obviously, that's not the price that Warner Brothers Discovery wanted to pay. So they tried to match Amazon. The league reviewed the proposal today. They say no go.
Well, talk more about that Amazon bid. Now that they have won the deal,
Sure.
What does it mean for them?
Well, it's an expansion on sports rights. They have the NFL, they have a bunch of sports documentaries. Now they get the NBA. Who knows where it'll go next? And they get the first rights for free agents. Chuck has said he's going to retire, but I don't know if I believe him.
So this is a done deal now. Do we expect other streamers to come into the NBA? Is there room for them to do special kind of games like Netflix did with the 2 NFL games on Christmas Day? Is there room for that?
I'm not sure. I think that all of the details will probably be fleshed out in the days to come. I'm sure press releases will come in the hours after the NBA puts out this statement. So we'll have to see. I don't know that Netflix would get, let's say, the Vegas tournament, the in-season tournament. It sounds like Amazon may have that. And, the rest of the games, the NBA has a lot of them, will already go to NBC and ESPN. So it sounds like this is done.
Okay. Again, this is not for the upcoming season, but the season after that.
Exactly. The 25-26 season.
And, we'll see the end of Charles Barkley as the host of Inside the NBA.
Yep, exactly.
Incredible. Bloomberg's Randall Williams, thank you so much for this latest on the NBA entering a long-term arrangement with Amazon for NBA games. All right, we've been hit with a tide of earnings. Let's get you a roundup of some of the most notable movers and bring in Bloomberg's Bailey Lipschultz, Abigail Doolittle, and Isabelle Lee. Bailey, why don't you start us off with ServiceNow?
Yeah, Scarlett, ServiceNow up more than 5% in after-hours trading. Sure, the company was hit in that landslide of a sell-off for AI-exposed stocks. But when you look at the quarterly beat, on the top line beating expectations, bottom line beating expectation, subscription revenue surpassing what Wall Street was looking for, even adjusted gross profit coming in better than analysts had been expecting, raising their full-year subscription revenue guidance up about $200 million, beating expectations. One thing, though, subscription adjusted gross margin just shy of what Wall Street was looking for the full year. But again, up more than 5%. This also comes as President and COO CJ Desai resigning from the company. This coming after a government contract complaint. But it does seem like investors are kind of putting that on by the wayside, just given the growth they've been able to see around AI and that subscription base. That's why, again, ServiceNow up more than 5% in after-hours trading, recouping a good chunk of those losses today. Abigail, what are you watching?
Well, moving in the other direction, Bailey, let's take a look at the shares of Las Vegas Sands right now, down about 3.3%. And it's interesting because they missed ever so slightly on net revenues. They also missed on adjusted earnings, 55 cents, a penny light. But when we go beneath the surface, some of the numbers weren't great, including Venetian Macau, the rolling chip volume down 27%, the Sands Macau down 33%, and then the Londoner Macau saw non-rolling revenue drop by 14%. So I think when you put all of that together, plus those small misses on the top and bottom line, that's why you do have the shares of Las Vegas Sands down about 3.3%. Isabelle, what are you looking at?
I'm looking at IBM, and shares are higher by around 3.5%. The company reported a jump in its booking of its AI business as customers continue to work and implement the latest technology. Bookings exceeded around $2 billion since mid-2023. So that's almost double the $1 billion mark we saw during the earnings seasons in April last year. So most of these bookings were in consulting and software. Revenue also came in better than expected, as did EPS. It's been really interesting to see how IBM evolved from this hardware legacy business into something more software, high growth, and services. And it's really made a lot of moves recently to expand its repertoire by taking over software companies like HashiCorp and Apptio. And now you can see shares still higher by 3.5%. And year to date, it's also gained 13%. Back to you, Scarlett and Shonali.
Bloomberg's Isabelle Lee, Abigail Doolittle, and Bailey Lipschultz, we thank you all very much for the latest. Now, joining us for more on IBM results is Anurag Rana, Senior Technology Analyst at Bloomberg Intelligence. And you look at those IBM numbers and you wonder, has IBM got a chance to compete harder? Because the stock has really trailed that of Google, and you saw what happened at Google. IBM is hitting above its weight right now.
Yeah, IBM software numbers came in better than what Street was expecting. And overall revenue also came in slightly better. But remember, this company is growing right now at 4%. Now, they did beat that 3% number, but, they have a long way to go before I would compare them to either Microsoft or Google at this point, because, those companies are growing in double digits. So when you look at IBM, it's turning around. It's slowly turning around, but we have a long way to go.
So is this a case where the stock is benefiting from fairly muted low expectations?
Yeah, I think it's a combination of muted expectations plus a bit of tech sell-off. People were expecting, I think, software numbers to be not as strong as they came in. Consulting was weaker, Red Hat was weaker, but there were a couple of other areas where they did very well, automation software and transaction processing software. And the last thing I would say is they actually upped their free cash flow guidance slightly, which is a good sign because for IBM, I think what they do with that free cash flow is going to be very important.
Very curious about some of the units within IBM because the headline number looks great on the AI promise. But you had, for example, Red Hat posting growth of 7%, relatively slow quarter from what it used to be. Consulting, some weakness, unit revenue declined 1%. Where are there spots that you're looking for more?
Yeah, I mean, both the things that you mentioned are, should be growing much faster than that. Red Hat should be growing in double digits, and consulting should be growing in 7% above. But that's in normal time, which is when we have normalized IT spending. What's happening right now is people are putting a lot of emphasis on AI-related spending, but their non-AI spending is going down, which is what you're seeing in the case of IBM. And not just IBM. We saw that with Salesforce. We saw that with Workday. We saw that with Accenture. So there is a lot of companies right now that need some help here.
You mentioned free cash flow and what it's going to use that for. We know that IBM has made some moves to expand this proposed takeover of HashiCorp and, of course, last year's purchase of Apptio. Is this something that regulators may take a closer look at, or is IBM, because it's no longer the dominant player it used to be, kind of gets a pass from regulators?
Yeah, we think IBM is under the radar. In fact, it is probably one of the better buyers right now in the market for anything that's available in the software infrastructure space. Because if you look at any of the big players, they really, cannot go out and buy anything. So I think it's IBM's advantage right now. In my view, they should be spending a lot more to make acquisitions when they can. Valuations are low for the entire software space. So it'll be nice to see if they can get another deal done by the end of this year.
All right, good stuff. Anurag, Rana, thank you so much giving us the instant analysis here on IBM, which did fairly well in its second quarter results, and the stock is moving higher in after-hours trade, reporting a boost in AI bookings and better than expected revenue. And Chanel, if you take a look at the after-hours movers, it's notable the change, certainly in color on my screen, from what we saw during the regular trading session. Yes, you've got declines like Ford, but look at Chipotle, look at ServiceNow, you look at IBM. Definitely, perhaps a bit of a recovery in the broader markets.
A bit of one. It's a really interesting after-hours trade because some of the exuberance you saw right off the gate when earnings released have moderated. You take IBM, for example, it was up more than 4%. Now it is up, I believe, around 1%. Ford, though, quickening losses. The psychology going into this earnings cycle was such that the companies that missed had actually dropped and less than average they've seen over the last couple of years in terms of a drop, according to Julian Emanuel at Evercore. And you have to wonder if what you've seen in the broader market might start to change that sentiment as this earnings season continues.
All right, this is the close on Bloomberg. All right, we're going to take a breather from the earnings bonanza and turn to the real estate market. We got data today that showed new home sales unexpectedly fell to a 7-month low. New data from the National Association of Realtors shows that there is a bright spot in the market. It's actually the lone bright spot, and it is luxury. Norah Mulinda joins us now. And Norah, I think your headline sums it up perfectly, which is the real estate market is broken for everyone except the ultra rich. You talked to a bunch of people. What did you learn?
Well, this is really a tale of two Americas. On the one end, you have a struggling consumer who cannot afford the high elevated mortgage rates that we've been seeing. And then on the other hand, you have ultra rich people who are able to actually pay for their houses in all cash, which was the most interesting thing that I found through my reporting. You would expect that maybe, of course, a lot of people are dodging the mortgage rates. They don't want to actually take out a loan and actually put money down for a new house. But then you have a large share of individuals, actually the largest share that we've seen for luxury new home buyers in more than a decade. They are putting down all cash payments to bypass the elevated mortgage rates that we're seeing.
Yeah, in your reporting, you say as of the end of first quarter, 45% 5% of U.S. high-end homebuyers used all cash.
Just a stunning number there. And of course, that this impact of higher interest rates have been impacting different cohorts of society in a lot of different ways. In terms of the housing market, what is the most troubling thing about this bifurcation?
I mean, I think there's a number of things that you can really point to here, but I think that one thing that I learned when I talked to different sources is that it seems to be a growing divergence. And so obviously when you're thinking about the economy and you're thinking about these elevated rates, you can even point to the opinion piece that we heard from former New York Fed President William Dudley earlier today, where he's saying he thinks that we should be cutting rates. We should be cutting rates at the upcoming meeting that we'll be seeing next week. And of course, everyone's really on the edge of their seats as to when that will happen. But it seems as though a lot of buyers are going to be remaining on the sidelines, especially as you think about millennials and other groups of people who are looking for a new home.
So you also talked to home builders. What are they doing in light of this data? How are they repositioning, or how are they strategizing?
So they do know that there tends to be an affordability issue. And of course, this story was in particular looking at high-end home builders. But you do see a lot of home builders who are using different strategies to make it more appealing and accessible, whether that be rate buy downs. We're seeing mortgage rates up about a little bit below 7% as I last checked. And they'll bring the rates down for you about to 5% or even lower in some cases, just to get people to buy.
But you know what's fascinating about this? You have places like even the Biden administration trying to say that they'll put in rent caps to make it more affordable for people to get in houses. The industry pushes back saying we need to build. We need to keep building. But the home builders you talk to tell a different story about the ability to build affordable homes.
Exactly. And one of the cases is that they end up having to build further out, which ends up being a bit of a problem, especially when you think about people wanting to have accessibility and getting close to the city. I know I'm one of those people myself, so I definitely understand where they're coming from in that sense.
And doesn't that just create another problem with this whole push of getting people back into the office? No one wants to go back into the office if your home is 90 minutes away on a good day when public transportation is actually working.
Rising cost of land, labor, and materials. Inflation still pinching makes it hard to lower costs on a house.
Yeah, and insurance. You got to get insurance. If you're in Florida or California, good luck.
Yeah, and all of the above. As a new homeowner, I'm also
you're grappling with all
resonate. Yeah. Hey, Norah, thank you so very much. It is a great story, one of the most read on the Bloomberg terminal. Do not miss it. And of course, this is going to be a political issue, Scarlett.
Oh yeah, for sure. I mean, as you mentioned already, it was something that President Biden had proposed before he decided to step down from the presidential race this November. So it may not gain any traction, but he knows that this is something that he needs to offer up to voters.
Yeah, and if you're a Republican or a Democrat, if you look at what they're asking many executives in Congress, it is the cost of housing, it is the cost of mortgages, and the longer this goes on, the harder it gets for everybody.
Absolutely. Speaking of which, President Biden is set to speak from the Oval Office. We're going to break that all down for you on what we should expect, what investors can expect. This is The Close on Bloomberg.
President Joe Biden's decision to stand down from a second term as the commander-in-chief will come full circle tonight when he is addressing the nation, of course, from the Oval Office for the first time since announcing on X his decision not to run again. Joining us for more on this is Courtney Rosenberger-Gelman, Managing Director of Policy Research at Strategas Securities. And if you think about what you're expecting to hear tonight, which part of what he says will be the most important? His decision, his support for Vice President Harris, or his track record on how he's navigated the country until now and what it means moving forward?
Yes, I expect we're going to hear about all of those things, about his decision-making behind dropping out, what he's accomplished so far in his term. But I also think he's really going to focus on what the next 6 months look like. He did not want to get out of this race. He got out because there wasn't a path to victory for Democrats with him as the nominee. So I expect he's going to be trying to talk about what the next 6 months look like. So things like Ukraine, efforts to push additional shipments and aid to ensure it gets there before the next administration takes power. I wouldn't be surprised if he talks about Israel and Gaza, especially after Netanyahu's speech today, his meeting with Netanyahu tomorrow. But it's important to note that the power dynamics here have changed. Netanyahu also has meetings with Harris and Trump. I think that he's going to talk about some of the executive orders and other things that he'd like to accomplish, things like student loan forgiveness. You all were just talking about housing. I wouldn't be surprised if he brings up his housing plan as well. Ultimately, though, I think for investors, it's important to note that the nature of his presidency and the political environment has shifted, though. Democrats are going to be celebrating Biden at the convention, but their focus is going to be on November.
Right.
Investors, I think, are largely looking at what policy looks like 6 months from now rather than what policy looks like for the next 6 months.
And we should say that Vice President Harris and Netanyahu are to meet at 4 p.m. Eastern on Thursday, according to a U.S. official. And if you think about the international politics at play here and the role of Vice President Harris in the administration while she's campaigning, how important is Biden's message versus hers right now? Where does she sit and where does he stand?
Yeah, I think it's really important because certainly the Biden administration does not want to put forward a message that Harris does not agree with because they ultimately want her to be taking over. They want her to win election in November. So I do think that we're going to see probably a more aggressive Biden if he does make remarks tonight on Israel and Gaza, potentially trying to do some public pressuring of Netanyahu. One, because that would be a legacy item for him. I think that he would love to end his presidency getting that ceasefire, but also because Harris has had a viewpoint that's a little bit more kind of focused on what's happening for the Palestinians than the administration might have had for the last few months.
And of course, we should mention as well, according to a U.S. official, the U.S. thinks the Israel-Hamas ceasefire is in closing stages. So that's something we'll be watching for, speaking of those international ties. When it comes to Vice President Harris and what investors want to hear from her, certainly policy is top of mind. But how much does her policy views mirror the current White House, President Biden right now? Because she hasn't said a lot on that. And when campaigning, it might be to her advantage to kind of stay a blank slate.
Yeah, so when we're talking to investors about this, because that's the biggest question that we've gotten this week is what does a Harris presidency look like versus a Biden presidency? We see the investment implications relatively similar between Biden and Harris. So the race hasn't really changed in terms of investment implications. What we're thinking about when it comes to November and what changes in January, it's trade. Democrats are going to be focused on de-risking. That doesn't change between Biden and Harris. Trump is going to be focusing on broad use of China tariffs, as well as targeting potentially Europe and Mexico as well. It's going to be on regulation. Do you have more or less regulation? Harris is very similar to Biden on things like financial regulation. It's actually more aggressive when it comes to climate. And then it's going to be on fiscal and tax. Harris has many of the same views that Biden had. We expect Democrats to try to do everything that they couldn't accomplish and build back better. So it's quite similar. She's more progressive in certain areas, but she's still likely to be handicapped by the Senate, which is very likely to go towards Republicans in November.
On the Republican side, what's interesting about the selection of J.D. Vance as his vice presidential nominee is that Vance is more populist than Trump when it comes to M&A. And he's talked about how, he, I believe, supports Lina Khan as the head of the FTC. How are you talking to clients about what M&A looks like under a Trump administration with J.D. Vance as a vice president?
Yeah, he is a conservative, as they like to call him. So we do think, when we're thinking about a Trump presidency, the top of the ticket is what really matters. So ultimately, it's Trump's viewpoint. And we do think that having Republicans in control does mean it's going to be easier for some of these smaller M&A deals to get through. But the populist viewpoint of the Republican Party is growing. So we are still cautious on some of the larger deals. We're still cautious in terms of big tech. But overall, we still think that this is a deregulatory looking administration, just with a slightly more populist tilt. And we don't think that Vance's views are going to drastically change what we would expect from a Trump presidency.
Speaking of vice presidents, there's a lot of wonder out there about who Kamala Harris would choose as her running mate. How important is this decision? What type of vice presidential pick would give her the best chances in November?
Yeah, so when we think of vice presidents, we think of limiting harm, because typically vice presidents don't do much for you, but they can very much hurt you. So with Vice President Harris, when she's choosing who her own running mate will be, that's going to be top of mind. Senator Kelly from Arizona and Governor Shapiro from Pennsylvania are the top candidates being discussed. Those would be our two favorites as well, especially Senator Kelly. He has the military background. He has his time in the Senate, and he also could potentially help deliver Arizona, which is a key swing state that Harris is going to be targeting. And he also probably helps her in the Pennsylvania, Wisconsin, Michigan, kind of blue wall states as well, where she's going to need help. Governor Shapiro certainly helps her in Pennsylvania as well, and gives a little bit more of a moderating force. So those are the two types of candidates that we're thinking about, because they do help at least deliver a key state.
And that's, of course, what everyone's waiting for as well. Courtney, thank you so much. Courtney Rosenberger-Gelman, Managing Director of Policy Research at Strategas Securities. And, of course, we're talking about President Biden's address to the nation tonight at 8 p.m. Eastern. You can catch his speech from the Oval Office right here on Bloomberg Television. Also, let's look ahead to what we're watching for tomorrow. Certainly President Biden speaking tonight, but earnings. And before the open tomorrow, we've got more results from airlines, Southwest and American among them.
Of course, we also have some more consumer, Dr. Pepper, Keurig, Hasbro, and after what we saw today, of course, every little line will be parsed through by investors. Aftermarket, Texas Roadhouse, Norfolk Southern, Deckers, lots of earnings still ahead.
And of course, eco data continues. We've got the first take of second quarter GDP. Right now, the consensus is for a 2% growth rate on an annual basis. Core PCE will be critical here. 2.7% is the consensus estimate right now, and weekly jobless claims. Also, the Israeli Prime Minister Benjamin Netanyahu scheduled to meet with President Biden and Vice President Kamala Harris. And quick mention, tomorrow at 4:45 p.m., former San Francisco quarterback Colin Kaepernick will be joining us on The Close for an exclusive interview. That does it for us.